With the rising cost of housing around the world, governments are trying to find ways to enable people into the housing markets. In the US, if you have a good credit score and under the right circumstances, you can get 3% deposit home loans. Here in Australia, the government has just created a program for single parents to put down only 2% for a home loan. Traditionally, 20% has been the minimum for a deposit on a home loan. However, the 2008 global financial crisis was triggered primarily by the US housing market being propped up by subprime loans to people who couldn't afford to pay for them. So just because you can get approved for a loan doesn't mean it's a good idea to take one up. So the question is, if you can get a 5% or 3 or even 2% deposit home loan, should you even take one? Are 2% home loans manageable? One common problem with any form of investing is that while the market is hot and everything is going up, it's hard to make a bad investment. If prices are consistently rising and houses are in demand, and you buy a house and your circumstances change, you can always sell the house and likely for a profit or break even. The problem is, what if the market slows or, God forbid, goes down? If you run into trouble and it's tough to make the payments, and even worse if the bank that lent you the money has to sell the property, if it's less than what you paid for it, you have to cover the difference. To understand this, first look at this from the bank's point of view. The 20% allows the bank to have a buffer where if the price of the house drops by 20%, then the amount they lose is minimized. Imagine you're going into partnership with someone and they will ultimately be responsible if you cannot repay your debts. However, you only are willing to put up 2% of the initial cost. Sure, the bank is going to make a lot of profit along the way, but they are also taking a lot of risk with very little buffer to recover. I want to make clear I'm making no judgment when I say the following, as saving money is hard, but by saving a 20% deposit, you generally have had to create some type of investment habits and financial strategy. In fairness, some people do get lucky and might inherit money or win the lottery or be given a gift to cover a 20% deposit, but for a lot of people, it comes from their financial literacy and planning. Again, no judgment, as everyone's circumstances are different, but building a 20% deposit also shows the bank you have a strategy and a track record to put money aside, which you can continue as you pay off the home loan going forward. Now, the other side of this is if you have a track history of paying rent, well, that's going to represent a lot of the home loan payment as well. In the case of the new Australian 2% scheme, the government will back the rest of the 20% for single parents based on income requirements and other qualifications. Which is great, but it also is important to remember that if things go bad, even if the government shoulders some of the cost, it's still going to be an issue for you. When you apply for a home loan, the bank will ask all types of questions about your spending habits, and they have to judge whether you'll be able to afford the home loan going forward. In the past, the banks would assume all costs would be the same going forward. However, this has become a little bit more of a grey area as they have been forced to consider that people's spending might actually be different when they own a home. For example, I might spend $100 a week on nights out while I'm renting because I have money left over after my expenses and I'm still able to save. However, when I buy a house, I might be able to sacrifice those expenses to meet my new financial requirements as a homeowner. That's just an example, but the point is that some people's expenses are completely different if they owned a home. The key point is just because you qualify for a loan doesn't mean that you should take it. Ultimately, you're going to be responsible for paying back the home loan, so even if the bank gives you a loan and even if the government runs incentives or backs part of the loan, you're still ultimately the one responsible. So if it goes wrong, it's going to be you who suffers the most. In the same way that just because you can get a credit card with a 20k limit doesn't mean you can spend that money if you want to be able to pay it back. I think these schemes are great for the right people and under the right circumstances, but for some people it's not. So I think it's important to look into the options, understand your financial situation both today and in the future, and then make an educated decision. Remember that just because the offer is available to you doesn't mean it's actually good for you. Further, credit institutions have a vested interest for you to take out a loan, so you may not necessarily get the best advice for them. Before making any serious financial decision, you should actually speak to financial experts. It may seem like a fair bit of money up front, but realistically over the long run, it's going to save you a lot of money. Even if it costs you a few $100s or a few $1,000s, in comparison to having a house foreclosed and going bankrupt, it's definitely worth the money. And also, they might even be able to point you in the direction of schemes that actually suit your financial situation and will put you in a better position. Also, as nice as it is to own a home and not pay rent, for some people it's better investing in other areas such as index funds, stocks, even crypto, perhaps even investing in a business. There are several different investment strategies with different benefits. Any investment you can't make the payments for is going to be worse than the one you can actually afford. Who's to say that stocks won't go up and house prices go down? Some people look at rent as dead money, but compared to a foreclosed home and bankruptcy, it's far from a dead expense. There are also a lot of hidden costs in owning a home that you have to factor in. Even just buying a home, there are all different types of upfront costs, such as lawyers for the sale, home loan establishment fees, taxes, transfer fees, even moving fees. There are many financial experts who even argue that renting is a better investment than buying a home. And a better alternative might be buying a cheaper investment property, improving its value via DIY improvements, and then most of the costs also become tax write-offs. Ultimately, every person's situation is different, and this is just food for thought, so this is not financial advice, but to get you thinking. If you enjoyed this, chuck me a like and subscribe to see more like it, and as always, good luck.